Microsoft just suffered its second-largest daily loss in history. In a single trading session, nearly $360 billion in market value evaporated. To put that in perspective, that is the entire value of Netflix, gone overnight. On the surface, the numbers looked good. Revenue beat estimates, earnings beat estimates, but deep in the cash flow statement, there is a number that terrified Wall Street. Microsoft is no longer just a software company. They are now a manufacturing company, burning cash at a rate we have never seen before. Today, we are doing a fundamental deep dive. We are going to audit the numbers, strip out the accounting tricks, and run a stress test valuation to answer one question. Is this a buying opportunity of the decade, or is Microsoft's cash flow about to be crushed for years? Let's get to work. Let's start with the headline numbers for Q2 fiscal year 2026. Microsoft reported revenue of $81.3 billion, up 17% year over year. That is a beat. They reported GAAP earnings per share of $5.16. That looks massive, up 60% year over year. But you need to be very careful here. That $5.16 number is an accounting illusion. It includes a $7.6 billion paper gain from revaluing their stake in OpenAI. They didn't sell that stake, they just wrote up the value. If you strip that out, the real non-GAAP EPS was $4.14, still good, but not the explosion the headline suggests. But the number that caused the crash is this one. $37.5 billion in capital spending. That is up 66% from last year. Wall Street looked at that bill and asked, where's the return? Before we panic, we have to look at the moat. Is Microsoft's competitive advantage intact? The answer is yes. Azure revenue grew 39% this quarter. For a business of this scale to be accelerating is unheard of. They are growing faster than AWS, meaning they are taking market share. And here is a critical detail. 45% of Microsoft's massive commercial backlog is now tied to OpenAI commitments. They own the infrastructure for the most important AI company on Earth. Companies cannot easily leave this ecosystem. If you are an enterprise using Office 365 and Azure, the switching costs are too high. The fortress is secure. The problem is the cost to maintain it. Now let's run this through our analyst checklist. 3 pillars: revenue, cash flow, and ROIC. Pillar 1 is revenue quality. We want to see double-digit organic growth. With 17% top-line growth and Azure accelerating at 39%, this is an easy pass. The demand is real. Pillar 2 is where the thesis breaks. We'll look for a free cash flow margin of at least 10%. Let's look at the cash flow statement. Operating cash flow, the cash generated from selling software, was $35.8 billion. But then look at additions to property and equipment. This is the cash they spent buying GPUs and building data centers. That number was $29.9 billion. Do the math. $35.8 billion in, $29.9 billion out. That leaves free cash flow of just $5.9 billion. That is a free cash flow margin of roughly 7%. Microsoft usually operates at a 30% margin. They are currently spending almost every single dollar they make to build AI factories. By our strict standards, this is a fail. Note, you will hear the media say CapEx was $37.5 billion. That higher number includes finance leases. But even using the cash number of $29.9 billion, the cash flow is crushed. Pillar 3 is return on invested capital, ROIC. Historically, Microsoft sits at 30% plus. But when you increase your capital base by $37 billion in a single quarter, your ROIC mathematically drops until those assets generate profit. We are marking this as a watch. The efficiency is degrading in the short term. So is management crazy? Why spend this much money? CFO Amy Hood was very clear. Azure is capacity constrained. Translation, they have more customers than they have servers. If they don't spend this money, they have to turn customers away to Google or Amazon. Management is making a calculated bet. Destroy cash flow now to secure a monopoly later. It is the right move for the business, but a painful move for the stock price. What is the stock worth? Most analysts are using optimistic models. We are going to do the opposite. We are going to run a CapEx trench model. We are assuming that for the next 2 years, Microsoft's cash flow growth is near zero, roughly 0% to 5%, because they keep spending on AI. We only let growth recover to 10% in year 3. We are also increasing our risk rate, WACC, to 10% and lowering our exit multiple to 18x. Even with this brutally conservative model, assuming 2 years of dead money, our fair value comes out to roughly $485. The stock is currently trading around $433. This tells us something huge. The market has over-panicked. The current price assumes Microsoft fails to monetize AI almost entirely. Here is the verdict. Microsoft failed our cash flow test today. The 7% margin is ugly, and it will likely stay ugly for another 12 to 18 months. But the stress test shows that even in a worst-case scenario, the stock is undervalued at $433. If you are a trader looking for a quick pop, stay away. This is going to be volatile. But if you are an investor with a 3 to 5 year horizon, the market just gave you a discount on the world's most important company. I'm buying the floor, not chasing the hype. But Microsoft isn't the only one spending billions. Amazon is next. If you want me to run this exact same stress test on Amazon to see if their logistics network is hiding an even bigger cash flow crisis, let me know in the comments. If you enjoy content like this, make sure to like and subscribe, as I will be posting more videos about investing this year. That's it for today's video. See you in my next diary.